It seems like the media is killing our property markets and even our economy because we're experiencing a crisis of confidence. So in today's show, I'm going to have a chat with Dr. Andrew Wilson, one of Australia's leading property economists, researchers and commentators, about what's causing this crisis of confidence. And it's not the economic fundamentals. As you listen in, you're going to hear us discuss the latest auction clearance results and what do they mean for the future, how our market compares with 10 years ago in the global financial crisis, a bit more about consumer confidence, what's likely to happen to interest rates, why selling your property at auction may be a thing of the past, well, at least for a while, and what could happen to property if Labor comes into power next year, plus lots more. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
Consumers are scared. Homeowners and property investors are worried. And the media is killing our property markets and the economy. Something's causing the crisis of confidence, and it's not the economic fundamentals. But homeowners and property investors are scared. I think it's because they're reading headlines like the Melbourne and Sydney house prices are falling by, $1,000 a week. They're reading things like a Shorten government's going to decimate the property markets because of its proposed tax changes. 1 million investors are going to need to sell up their homes because their loans are going to convert from interest only to principal and interest. No wonder they're scared. But should they be scared? Are the headlines right? Well, today I'm going to chat with Dr. Andrew Wilson, economist at myhousingmarket.com.au. We're going to tell you what's really going on. In my mind, investors are investing and making decisions based on media reports, not the fundamentals. And that's the wrong way to do things. You don't make 30-year decisions based on the last 30 minutes of news. But the problem is, the latest ANZ-Roy Morgan Consumer Confidence Index shows that consumer confidence is below its long-term average, the average that's been held for the last couple of decades. And I know a lot of our clients at Metropole, when they have their annual client review, ask, well, is it time to sell? Should I get out? They're worried. Of course, the answer is you don't make long-term decisions based on short-term factors. It's not the right time to change your property strategy. But what's changed? What's scaring investors? Now, remember, different consumers are scared by different things. But there just seems to be so many factors in the market at the moment that's concerning people. You know, I've never seen the media as negative. There's not been as much negative press about house prices heading south, not even during the global financial crisis a decade ago. Maybe it's just the way the media works today with clickbait. You know, that 60 Minutes show really got lots of ratings, but it wasn't based on substance. See, we're seeing headlines talking about rising interest rates, but they're wrong, as you're going to hear Dr. Andrew Wilson explain in a moment. We're hearing headlines that since APRA and the Royal Commission has been regulating the banks, it's getting harder to get money if you want to buy a house. The recent Wentworth by-election result and the fact that now we've got a minority government and maybe the fact that we've got a federal election coming up, maybe sooner rather than later, that's worrying people. There's uncertainty about the various state government elections coming up in Victoria and New South Wales. And boy, the stock market's taking a dive, isn't it? At the same time, people's wages aren't going up. Increased petrol prices at the highest level of a decade. Unbelievable when you go to the petrol pump. And that's got to be scaring some households on a tight budget. At the same time, energy prices are going up. Now, a short while ago, I was having lunch with Dr. Andrew Wilson, and we were talking about property. Interestingly, it was so interesting that the guy at the next table came up and said, "Hey, can I sit on your table? I want to hear this conversation as well." So I said to Andrew, hey, we've got to record this. So I pulled out the mic and we're going to have a chat in just a moment. And Dr. Wilson's going to talk about, we're going to start talking about the poor auction clearance rates for the spring selling season and what that means for the market ahead. We're going to talk a bit about how our current market compares with the last big downturn, not the little one in 2012, but the big one in a decade ago during the global financial crisis. We'll talk a bit about consumer confidence, obviously. And I think you'll be interested surprised in what Dr. Andrew Wilson believes is going to happen to interest rates. He's also got some interesting predictions about selling a home at auction may be the thing of the past, for a little while. And we'll talk a bit about what could happen to property if a Labor government comes into power. So, as always, I love having a chat with Andrew. I'm sure you're going to enjoy it as well. And at the end of that, I've got a mindset session with you today. I'm going to give you 6 thoughts on failure. So, lots to cover. Let's get on with the show as I speak with Dr. Andrew Wilson, Chief Economist of myhousingmarkets.com.au. Andrew, we're in interesting times in the property market. It seems like we're having a crisis of confidence.
Well, absolutely, Michael. We've had a remarkable spring selling season as it's evolved. Of course, spring is that period in the market where we do see listings and buyer activity on the rise, and various reasons, of course, that buyers or sellers, most buyers are sellers and sellers are buyers, of course, and they start focusing on that finalisation of their transactions by the end of the year. Let's get it done and dusted. And the mantra was always that it was a good time to sell early in spring and a good time to buy late in spring as listings started to rise and sellers became a little bit, nervous about closing out the year. Now, this year we started the spring selling season off in quite a reasonable sense that listings did rise through August. We also saw high clearance rates through August in Melbourne and Sydney particularly. But really the September just ran out of steam, and I would hate to think that this was the catalyst, but it certainly the 60 Minutes program it seems to have had an impact generally on the market, which is really concerning. That
something happened just around that time. Yeah. The market lost its confidence. Yeah. So it was a combination of a whole lot of things. But Andrew, the fundamentals are better than they've ever been.
Well, this is the remarkable scenario that we're faced with at the moment, Michael, is that the market has clearly backtracked over October. Clearance rates ended October below 50%. Now, we have to go back to 2008 in Sydney and Melbourne to see clearance rates consistently below 50% at this time of the year. And of course, that time of the year was the global financial crisis. And the word crisis, global and financial, says it all. Of course, we were going to have issues with confidence because the world didn't know where the economy was heading. But quite perversely, we have the drivers of the housing market are at the complete opposite end of the scale as we speak. We have a very strong economy. Latest unemployment numbers show that our performance in the labour market is the best we've seen in 6 years since the peak of the mining boom. We're creating jobs. We have strong migration. We have a boom in first home buyer numbers. Most rental markets are tight with rents increasing. And of course, we have the lowest interest rates on record, and the Reserve Bank has clearly indicated that there's no chance in the foreseeable future of seeing higher rates. So this is completely the opposite circumstances in a sense to what we saw when we had clearance rates at the same level. But really, quite clearly, the market has lost its nerve, and this is all about confidence.
The clearance rate is an indication of people's confidence. People are not taking the move to buy new homes. But what's causing it, Andrew? We had also, I think, a concern about a future government changing some of the rules. Now, that's only going to affect investors, but if it does affect the investor market, it is going to affect the price of your and my home too, isn't it?
Well, absolutely. And look, if we look for reasons, and I guess we can speculate on the impact of generally of news media and the negativity that's sort of infected confidence in the marketplace. But there is no doubt that banks have tightened lending this year. Banks, of course, this isn't a new event. We had those APRA-generated tightening of lending to investors that started in 2015, came back again in 2017. And really that's been the pebble that's caused this avalanche of negativity in a way, because we've also seen banks move in, irrespective of those financial regulation policies, to tighten their lending, and that's come from apparently the Royal Commission into the financial sector. Now, the interesting thing here is we must realise that in times gone by, that the tightening of credit was a response to a weakening in the housing market. In other words, you'd see fewer buyers and sellers because we'd have the factors driving that, the real factors, which would be either higher interest rates or higher unemployment. And then that would cause, obviously, fewer loans. Now, we've put the cart before the horse here, Michael. We've now got the bank coming in before anything occurs and tightening lending. And of course, this becomes self-perpetuating. It reinforces it. As banks have tightened their lending, it means fewer buyers, which means fewer sellers, and then banks see that the decline in the marketplace in terms of volumes reflects a market that's declining. So therefore they tighten lending again. And this is really bizarro world at the moment. Now, the whole point to confidence is that it is this immeasurable mindset that buyers and sellers, consumers have. Now, I always like to compare confidence with a big ship. It's like the big ship surging along in one direction, and it's very, very hard to turn that big ship around the other way. Now, when we have confidence at the high level, in other words, high confidence, it can take a while to shift it back. But it's even harder to shift a negative mindset into a positive mindset. The problem that we have at the moment, Michael, is that typically in this market environment, when confidence is low, we see a change in confidence driven by a change in the significant or the real factors of the economy. And that would clearly mean lower interest rates or an improved economy. But we don't have that to drive a change in confidence. In fact, what we have going forward, and I know I'm speaking rapidly and with a lot of, but what we have going forward is even more roadblocks to this confidence. And that is, we've got an election in Victoria coming up in November. We have an election in New South Wales March next year. And then, of course, we have the federal election in the middle of next year likely. And as you've alluded to, if we do get a change in government, we also have the prospect of this radical change to the tax treatment for investors. And again, that will, even if it doesn't have the types of effects that I believe and many others believe it will in the sense of lower prices and higher rents, it will still mean that buyers and sellers will continue to be wary until this the effects of it pans out. So I think we're in for this wary, very circumspect market environment with fewer buyers and sellers, waiting to see how things are going to pan out, despite the fact that we have these very strong underlying conditions where clearly underlying demand is ahead of supply.
Well, clearly that means then those who can see the big picture opportunity and invest based on fundamentals rather than making their investment decisions based on the media are going to take advantage of the opportunities the market offers them. But Andrew, for many years you've been saying interest rates aren't going to go up. They're more likely to go down before they go up. How do you feel about that today?
Well, I think that case is strengthening. I think the drums are starting to beat even louder for an interest rate cut. The Reserve Bank has been quite adamant that the next rate cut, when it occurs, was more likely to be up. I'm concerned that perhaps they've painted themselves into a corner here. We do have this shakeout occurring in the housing market. I don't want to call it a downturn as yet, but the point is that some people do have to sell their properties for circumstances beyond their control. They have to take what the market offers them, and if buyers are sitting on their hands worrying about how far this market may fall, it means that again becomes a self-perpetuating impact on downward prices. I'm not sure the Reserve Bank would be happy to see a continuing fall in house prices. If asset prices are falling. Income growth is very low at the moment. It means that this will eventually have an impact on the economy going forward, even though we are having a very strong economic performance at the moment. But the big thing is incomes. We're seeing the highest or the lowest proportion of the savings ratio at the moment. We're already seeing consumers dipping into their savings to pay at the highest rate since the GFC, or the 2007 before the GFC. And of course, in those circumstances, they were spending like drunken sailors because it was a boom economy. Now it's the reverse. People are diving into their savings because they have to find something to spend because their income growth is so low. And of course, we're now starting to see people marching in the streets because of this income growth. And this may lead to industrial action, which can only have a negative effect on our economy. And, and you can't blame people for being frustrated for year after year, seeing no real growth in wages. And, really we're constrained in terms of policy solutions here. And I believe that the Reserve Bank will be forced to act to try to get dollars back in people's pockets and to perhaps get some confidence back into consumers.
We know consumers are not confident, but they're also confused because when you look at the various reports, some research houses say property values are going up, some say they're going down, some say they're remaining the same over the same time frame. What's going on, Andrew?
Well, look, measurement can always be problematic. I'm a member of the Royal Institute of Chartered Surveyors. Which means I'm actually an old school quantity surveyor. So measurement is my craft, and measurement in house prices can, have various different methodologies. But certainly, if we look at the volumes involved in the marketplace at the moment, they're quite sobering. This year, we've seen a drop in listings of around 16%. In Sydney, this is in the auction market, which does reflect the broader market. In Melbourne, listings are down 8% in terms of the number of sales this year compared to last year. This is spring compared to last spring. We've seen sales down in Melbourne and Sydney by around about 35%. And then if we look at the actual volume of property, the value of property sold, so that's the volume per value of property sold this year. In Melbourne, it's down this spring compared to last spring by nearly 40%. And in Sydney, the value of property sold is down by around 50%. So that's a different measurement factor. But what it shows you is there's fewer buyers, fewer sellers, and the properties that are being sold at a much lower price. Now, whether that's fewer higher priced properties or whatever, the point is that the real estate dollar has shrunk this this spring compared to last spring, and a lot of that is because the actual number of buyers and sellers has sharply declined.
So what's going to happen to the auction system in Australia? It seems like it's not sensible unless you've got something really special or unique to take it to auction.
Well, this is obviously a deep concern to the way the industry's developed since the boom started, particularly in Sydney, Michael, and that's that, auctions were obviously the way to go because there were 4 buyers, 5 buyers, 10 buyers, 20 buyers to every property. So, of course, you're going to auction and get, that was always the mechanism to maximise your price. And, vendors were quite happy to pay high advertising costs to, bait the hook to get as many buyers, potential buyers, there to auction day. And, they would, during the boom period, certainly reap the rewards of all that competition. But now, where's the sense of going to auction if you've put 6 weeks of your life on hold with people tramping in and out of your house and, you've spent all this money on refurnishing and refurbishing, and then your advertising costs and all these other costs involved in the auction campaign, and then come the day of the auction and nobody shows up. And we're seeing that occur. So obviously vendors are going to start, getting back to, I guess, the old ways of selling property, and that is to say, well, I'm quite happy to pay a commission for the sale of my house, but I'm not paying anything unless I get a sale, and that really does put the emphasis and back on the agent as it used to be. And this will mean, I believe, a significant shakeout in the industry. But certainly the era of auctions is behind us currently. Now, inner city properties, because they are at a higher level in terms of being sought out by buyers, will always have the competition factor that will favour auctioning. So I'm not saying auctioning will finish, but I think it will become more, restricted to those inner suburban higher priced areas that traditionally really were auction areas. And I think most other properties will be. I think Melbourne will stand out. I think Melbourne will track back to around about 20% of all activity will be auction activity. It's around 35% now, or was at their peak. And I think Sydney will get back to under 10%, which it was traditionally. And, as I said, I think this means that agents have got to, we will have a much different industry, I think, going forward. And it also obviously has implications for the big portals such as, realestate.com and Domain, because I think that vendors are just not going to be prepared to put their hand in their pockets to pay for advertising if they can't be guaranteed of a sale.
Now, we're almost starting to sound like 60 Minutes. Is it all,
heaven forbid.
Is it all doom and gloom, Andrew?
No, but that's the point, Michael. It's not doom and gloom. It's bizarro world because, we have strong fundamentals for property in this country. We're not having a global financial crisis here. In fact, our economic numbers are as good as they've been since the peak of the boom, except for incomes growth. But that's a worldwide conundrum. We still are an undersupplied country in terms of our property markets. And that's ever been thus the case through the cycles. It's just that confidence is the key. And once confidence returns, of course, the market will recalibrate. And once the market returns to its fundamentals, which is the supply and demand fundamentals, it will catch up on what it lost during this period of negativity. But of course, it requires a shift in sentiment. Now, that shift will come eventually because people move on with their lives. They have children, they retire, they go into state, they get divorced, and sadly, they die. And that means that, but beyond just the things that do occur that you have no control over, people will start to move on with their lives over time and realise that there's not going to be a significant shakeout based on the usual factors. That this is something that, really is encapsulated by the saying, there is nothing to fear but fear itself. And this will work its way through the system. But of course, we still have roadblocks to that re-emergence, and that is the election cycle that's coming up, and also the introduction, perhaps, by Labor of its negative gearing policies, which really is, quite problematic in terms of the market.
It is a potential worry because it will affect a significant portion of the market. How is the market made up? What's the percentage of home buyers, first home buyers, established home buyers and renters?
Well, look, I guess if we can simplify the policy in a sense, we can say that the market is, in terms of buyer proportions, on average through the cycles, is around about 40% are investors, around about 45% are owner-occupiers, and the remaining 15% are first home buyers. So what we're saying is if we're trying to restrict, the ALP are trying to restrict buying activity from that 40% of the market that are investors. Obviously not all of them, but that's the aim, is to take that investor activity away from the established market. So I guess that means that if you're an established home seller, that you will not have that 40% of the market or proportion of such who would be interested in buying your property. So if you have a narrower pool of buyers to choose from when you sell, because investors don't get negative gearing for established properties, then that means obviously some downward pressure on prices. It must. And of course, the other point to the equation is that if you have fewer investors, that means you have fewer investment properties. And we have tight rental markets everywhere except Sydney and Perth and Darwin. It means not good news for tenants with fewer investment properties, because that will only mean higher rents in tighter rental markets, which was the lesson in 1986, of course, when they changed negative gearing then. So, look, there's a lot of certainly querulous circumstances here in terms of this policy. But certainly the one you can't argue with is the fact that it will impact confidence. And that is what's dragging this market down at the moment.
Now, clearly, if that policy does come in with negative gearing, it won't affect all properties the same. It will affect those areas, though, that are more investor-focused, those locations which are more investor. And the value of your and my home, if it's a good suburb and a good family home, is less likely to be affected. It's going to marginalised property. There'll be good properties and secondary properties. And all those people who buy new properties, all of a sudden they're second-hand, they're going to have troubles as well.
Well, that's exactly right. It just keeps, moving. It's a movable feast of scenarios. And it gets back to the, leave well enough alone. I mean, the circumstances of the policy for negative gearing that Labor introduced was based on affordability. We were going through a very strong period of prices growth. There was a sense that investors were crowding out first home buyers because of high levels of activity that we always see when the market's at its peak. Investors are attracted by capital gains. We see a higher proportion of investors in the market. We see a lower proportion of first home buyers. But that's turned around on its head 180 degrees in the last 12 months, Michael. We now have seen surging first home buyer numbers as courtesy of those changed stamp duty. Prices are falling now, and investor numbers are back down to that long-term average of around about 40%. I mean, the issues of affordability, which are always there, it's always tough to buy your first home. I mean, that's the whole point of aspiration. It's not an easy gig. It's always been tough, and that's why we aspire and feel great about it when we do buy our first home.
And when you get in, you don't want the market to fall further.
Absolutely not.
People they're helping are going to be cross if the market falls further. So the policies will affect people differently. But interestingly, if they were reasonable people, these politicians, they'd say, hey, that was appropriate then. The world has changed. And I think we'd think more of them if they said, okay, I'm actually changing the negative gearing policy, but it seems ingrained in their psyche, in their gut, that ugly, greedy investors shouldn't own properties.
Well, there's always a trap in economics that if you get, sidelined by ideology, and I think a lot of economics sadly gets infected by ideological, views of what, the distribution of income should be, etc. And this is always very dangerous. I think you need to look at the fundamentals, and the market has changed fundamentally in the last 12 months. In fact, as I said, 180 degrees, it's the complete opposite. And, if circumstances change, then policy should change as well. And, I think the issue particularly is the impact on a very fragile, very wary marketplace at the moment that any significant change to policy is likely to have, regardless of arguments of higher rents and lower prices. I think that this is the last thing the market needs, is a significant change to the way of the tax treatment there. And it is a market which is now is driven by sentiment clearly, and that is always a very difficult thing to change.
The old story: fear or greed.
That's
Before
right.
it was greed, the fear of missing
Exactly.
out. Now it's the fear of buying early. FOMO.
That's right. Yeah.
So the bottom line, Andrew, there are headwinds ahead, but we've got strong fundamentals.
Fundamentals are extraordinarily strong, and that's the point.
Thank you for your time, Dr. Andrew Wilson.
My
Chief
pleasure,
Economist.
as usual, Mike.
Well, as always, Andrew came up with some really interesting ideas, didn't he? In a moment, I'm going to be back with my mindset moment, where I discuss 6 thoughts on failure. So let's have a short break, and I'll see you on the other side with my ever-popular mindset moment.
If you're unsure what to do next in our changing property markets, why not turn to the proven and trusted team at Metropole Property Strategists to take advantage of their expertise of profitably investing through the last 5 property cycles. The team at Metropole have been involved in over $3 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development, or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In this week's mindset message, I'm going to have a bit of a chat with you about failure, because I've come to realise that too many people worry about failing. And because they worry about failing, they don't take the next steps and move forward. Now, I've had my share of failures, and to be honest, most of them have been self-inflicted. So today I'd like to talk with you about failure and maybe give you a different perspective on it. The first thing I'd like to mention is that failure isn't permanent. You know, that sinking feeling, the knot you get in your tummy, it won't last forever. And the best way to reflect on your failures is to focus on the lessons that you've learned and the person that you've come, rather than spending your time avoiding failure. See, you become a different person when you go through the failure and learn a lesson from it. So the less time you spend on the rejection, the faster you're going to grow. The next message I'd like to give you is own up to your failures, because the moment you openly talk about the things that make you vulnerable, interestingly, they no longer have power over you. People are going to appreciate your honesty because everyone knows what it's like when you've had setbacks, when you've had mistakes. We've all had them. People are going to respect you for owning up to your problems and embracing your failures. And that way you become stronger. I guess another important theme that comes through my mentorship messages regularly is the world's not going to change unless you do. You know, the world owes you nothing. It was here first. So we can't blame the shortfalls in our life or the people around us or our past for the decisions that we make in the present. It's not the events that define who you are. It's how you choose to react to what's happening to you that defines who you are. So forget what others say. They're going to judge you anyway. If you want the world to change, you've heard the message before, you've got to change yourself first. I guess another theme when we're talking about failures is how badly do you want it? As Steve Jobs once said, if you don't love it, you're going to fail. Thomas Edison made 1,000 unsuccessful attempts at inventing the light bulb, but from his perspective, he didn't fail 1,000 times. The light bulb was an invention that took 1,000 steps. Now that's an interesting perspective, isn't it? Another thought about failure is just because you failed doesn't mean you are a failure. Never let failure determine your self-worth. If your head hurts, you say, I've got a headache. You don't say, I am a headache. Failure is nothing more than an event. So don't personalise it. And the last message I'd like to share with you is failure is part of the process. The fastest way to success is to double your failure rate. Successful people have failed more times than beginners have even tried. So if you want to succeed, fail faster. You've probably heard me say it before that I'm a real success at failure, but I've got up one more time, every time, each time, one more time than other people, and over time, I've become successful. That's my mindset message for today. You are not a failure. Don't be defined by what's happened in the past. Learn from it and move forward, and you'll also become more successful. Well, as we're getting near the end of the show, I want to read out one of the reviews I received recently, and this one's from Great Britain. In fact, it's interesting. Our podcast ranks highly in Great Britain, in Zimbabwe of all places, Pakistan. I can see where the iTunes chart shows people are listening to us, and they're listening to us all over the world. And Jig from Great Britain wrote, Hey Michael, congratulations on your podcast. I've been listening to it for some time now. Thank you for sharing your golden nuggets. They're very helpful. I see a lot of similarity between the Australian and UK markets. I love your mindset moments, which help delve deeper into the changing mindset. Keep doing what you're doing. Best wishes, Jig. Well, thank you, Jig, and thank you for listening from afar. I guess that's the beauty of technology now, isn't it? Doesn't matter where you are. And thank you for your comments about the mindset moments, because I know that's the most regularly commented section about. Even though you're overseas, if you send me an email with your details, michael@metropole.com.au, I'd be happy to give you a book as a way of saying thank you for leaving a review. Same to you, the person who's listening right now. Please leave me a review. It helps others find out about the show, and I'd be happy to gift you a book, any of my books, when I read out your review. Also, quick request, if you got benefit from this show, let's help others not be scared by all the negative sentiment and all the news. Let's teach others to invest on fundamentals, not because of the media. So please tell a couple of friends about this episode of the show. Share it on Facebook or Twitter. Let's not let the media beat us, because there are some great times ahead for the Australian property market. And I look forward to catching up with you again next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.